focus to the banking pact then. BoB, Mr. MD Mallya, CMD of the bank, joins in on the show. Mr. Mallya, hi, good morning. Firstly, the RBI has eased liquidity in the system by cutting the SLR, and the largest bank has already moved to ease rates on home as well as auto loans. Would you as well follow suit?
See, basically the RBI action was anticipated in the background of the current macroeconomic scenario. I think they have retained their stance very clearly, that is regarding anchoring inflationary expectations while at the same time not compromising the overall growth impact. But then one good thing they have done is the fact that the governor has reduced the SLR from 24 to 23%. It gives a lot of comfort in terms of liquidity availability to the system, for making lending to the productive sectors of the economy. I think that's been a good move on the part of the RBI governor, and overall therefore I don't think any of the productive sectors will be starved of funding from the banking system as we move along in the current year. Then of course looking at the interest rate scenario, as of now, I don't think there would be any immediate impact in terms of reduction of the rates of interest. We need to look at a couple of things. One is the need for credit picking up, the demand for credit picking up, and number two, the liquidity which is available with the bank vis-a-vis the overall asset liability requirements. As far as the Bank of Baroda is concerned, the ALCO needs to meet and take a call on that. So I would not be able to tell at this point in time whether we would be changing our rates of interest on the deposits or any of the segments of the lending. It is too early for me to comment. But then overall, I think the stance would be very clear that we will not starve any segment for credit from the bank also, while at the same time will be cautious in terms of our pricing needs.
Mr. Mallya, do you think you have little headroom to cut your base rate?
I think we need to evaluate as to what exactly our situation is in terms of the overall structure of the our liability position and the need for our incremental funding requirements vis-a-vis the overall likely credit growth for our bank. That's what ALCO has to do when they meet maybe early next week. But at this point in time, I am not able to very clearly say whether there would be any change as far as the interest rate structure in our bank is concerned.
Mr. Mallya, do you feel the move by the central bank to ease liquidity in the system will help banks like yours make more credit available to productive sectors as pointed out by the central bank itself?
No, absolutely. I don't think there will be any shortfall in making available the credit to the productive sectors. As of now, of course, the liquidity is reasonably comfortable. The overall LAP borrowings is well within the comfort zone of RBI, less than about 1% of the NDTL. And therefore, immediately there may not be any need to resort to this reduction in terms of the SLR. But the message is very clear going forward when the credit needs go up, when the credit starts picking up, whether the banking system would be able to have enough liquidity to meet the requirements of the system. I think to that extent this comfort that SLR reduction from 24 to 23% is a big boost in giving us the comfort that the liquidity would be certainly available at that point in time. But then there could be some banks which do not hold substantially higher SLR than what is required. I think to those banks, to the extent of the current reduction, would immediately have a positive impact in terms of liquidity.
Mr. Mallya, if I look at the deposit growth trends, there clearly is an issue there. Now, since Bank of Baroda has a strong CASA ratio, low deposit growth may not be an issue for Bank of Baroda. But how do you see industry in general will tackle this issue?
See, if you look at the recent numbers, as far as the year-on-year growth of deposit is concerned for the system, I think that the system would have grown by about 14.5% or thereabout. It is a sharp decline to what it was last year similar period. I think it was around 16.5 to 17%. See, obviously we are passing through a deceleration as far as the economy is concerned. Number two, the inflation is still reigning high, and therefore the real rate of interest to the depositor has been reasonably less. On top of that, the other factor that needs to be considered is the fact that when the inflation is high, the consumer preference sometimes is to invest in physical assets rather than keeping the funds with the banking system. Therefore, perhaps the consumers would now prefer to perhaps take gold, purchase gold, rather than keeping deposits in the banking system. I'm only giving an example. So therefore, it is a general phenomena which we observe. When the inflation is high, the deposit accretion decelerates to a small extent. I think that is what we have been seeing in the recent past. This could continue as long as the inflation remains high. But then once the inflation starts moderating, I think to that extent, I think the funds flow back into the system by way of incremental deposits will also increase. One more factor again here which we need to consider is the fact that when the inflation is high, perhaps the overall propensity to save for the customers also comes down, and to that extent the savings will come down, which will have a negative impact in terms of deposit accretion. So therefore all these factors put together cumulatively would have had an impact as far as the deposit accretion and the growth in the recent times is concerned. So one needs to therefore wait for the real improvement in terms of the macroeconomic conditions. I think that will set off a sort of a cycle which would bring in incremental deposits, credit pickup, savings and the things like that.
So Mr. Mallya, would you be looking at cutting deposit rates given that most large banks have already cut their deposit rates?
See, it is governed by quite a number of factors. Couple of them important. One, the liquidity. Number two, the credit demand. So the entire interest rate scenario is governed by these factors, and therefore at this point in time one can only say that credit demand continues to be rather lukewarm, and therefore raising deposits at high cost may not really be the reason for the banks to increase the deposit rates. So therefore I don't think deposit rates could go up anyway at this point in time. It could slightly moderate. It depends on how exactly we look at as far as our liquidity is concerned. That is why perhaps one would have seen a couple of banks reducing the rates of interest after the policy, which would have been driven by the fact that there's a comfort in terms of liquidity being available with the SLR reduction, and therefore again the other thing is that the credit pickup is really yet to be seen. So this may be a trigger for the reduction in the deposit rates.
Mr. Mallya, give us a sense of the asset quality for the banking system and then for Bank of Baroda, and in general, where do you see new pressure points emerging from?
The asset quality has been impacted because of the stress experienced by a few segments. This was anticipated. It is not as if that suddenly we are seeing that there is a deterioration in asset quality. There has been a deceleration in the economic growth. Therefore, obviously, the stress on few segments was expected, and that is what has happened. But keeping this in mind, if you look at the numbers which have come out from the various banks, I think it is not too bad in terms of the deterioration of asset quality. NPAs have definitely increased, delinquencies have increased, but I don't think it is beyond what one was expecting it to happen. So therefore, going forward, what would be the scenario? To my mind, I think that the pain points will continue for some more time. It is not as if that we have seen the end of the cycle, but then I think whatever one would expect in the coming few quarters is a manageable sort of a situation for the banking system and not too difficult. Now, looking at how Bank of Baroda has performed in the recent quarter, the results have already come out. The delinquencies have been less than what it was in the Q4 of last quarter. The incremental restructured assets have also been reduced substantially vis-a-vis the last quarter. But still, I would say that this was what was expected, that was the guidance given, and therefore we are well within the guidance which was already given to the stakeholders. But let me once again reiterate that the pain points will continue for some more time. Delinquencies will be slightly higher than normal for some more time, but then gradually with the improvement of the overall situation, with the sort of economy bouncing back, or maybe at least trying to inch up from the current levels, I think that the overall situation should substantially improve, from which point we can expect the stabilization of the overall asset quality, reduction in the delinquencies, and that would be good for the system at that point.
Mr. Mallya, in terms of restructuring, could you give us your views on the new norms proposed by the RBI, and also what is the restructuring pipeline looking like for you guys?
See, at this point, these are only draft guidelines, but given the fact that some of the recommendations are relevant from the point of view of building on our overall balance sheet strength, I think one would be also positive on some of these recommendations. What they've indicated is that on the restructured asset portfolio, the standard asset provision should increase from the current level of 2% to 5%. That too in two phases, 1.5% each in the next 2 years. Now, given the overall restructured portfolio, I think this increase may not be too significant, but then of course it depends on the specific portfolio of a particular bank. Now, look it from the point of view of Bank of Baroda. We have a overall aggregate restructured portfolio of around 15,000 crores. So therefore, if we knock off those restructured assets which are performing well and they have completed a 2-year sort of a moratorium in terms of proper performance, I think these assets gets released out of the restructured portfolio. And therefore, the 2% provision which were made there against would come down to 0.4%, releasing a substantial amount of provision already held. Vis-a-vis that, for the balance of the portfolio, one has to increase the provision by 1.5% each in the next 2 years. I think by and large, I don't think there will be any steep increase in terms of the requirement of the provision for our restructured portfolio. But then in case there is any marginal increase, I think our operating profits are good enough to take care of these incremental requirements of provision.
Final question, Mr. Mallya. Bank of Baroda has a huge exposure to agri sector. Given the way how things have moved when it comes to rainfall and monsoon, are you a bit worried about that exposure?
Difficult to say what type of an impact one would be seeing, because we are yet to really assess what is the real impact in terms of deficit monsoon. Monsoon has not been deficient in almost all states uniformly. There have been a couple of states like Karnataka and Maharashtra where the monsoon has been really deficient. There could be other states which have seen a reasonably good monsoon till now. So therefore, overall impact difficult.